Hello and welcome back to The Note. Let's try to take the temperature of the emerging markets once more today. There's been a very clear trend for about 3 years now that emerging markets are steadily falling out of favour compared to the developed world, and there also at one point appeared to be quite a clear trend of a fresh differentiation within emerging markets, that those countries that had strong or serious current account deficits were falling out of favour. That trend, however, has muted very considerably in the last few months. So how exactly should we treat the emerging markets asset class, and how should we go about investing in it? With me now to try to answer those questions is the Chief Investment Strategist for BlackRock, Russ Koesterich. Russ.
John.
Thank you very much for joining me in London once more. Let's start by taking a look at the overall picture. Somewhat familiar at this point, a remarkable rally for emerging markets right through the last decade, and in the last few years that's steady moving off the boil. What do you think is the driving phenomenon here? Why is emerging markets behaving this way?
I think there are two reasons, John. They're somewhat related. The first of which comes down to valuation. If you think about where emerging markets have typically traded, they've normally been at a significant discount, around 20% to developed markets based on price to earnings. And that makes sense. They should trade at discount given questions about property rights, corporate governance, etc.
Yeah.
In late 2010, when the underperformance started, they were actually trading at par with developed markets. So at that point, there was arguably too much good news baked into these companies. The second reason is, again, going back to what people were thinking in late 2010, there was a lot of optimism about China, about India, Brazil. You know, these countries were going to grow at 8, 9, 10% forever. And clearly that has not happened. We've seen a material slowdown in most emerging markets, and that has undercut the story that really attracted many investors to this asset class over the last 5 or 10 years.
Okay, so we're having some sort of general pullback to reality. Is there some sense that they're also a riskier asset class? If you're expecting a greater long-term return, presumably you have to accept the quid pro quo of all finance, a higher risk. Is that driving this as well?
That is exactly correct, and I think, again, it's a lesson that a lot of people forgot. So if you look at the volatility of EM equities over the last 20 years, the volatility is considerably higher than developed markets. This is
obviously very dramatic. It was a developed world crisis in 2008, but it hurt.
You saw even more in emerging markets. And this is what people have to accept. And exactly to your point, that higher return, which you can see on this graph, has over time, as you would expect, come with higher volatility. So what we've experienced in the last year or two, this is normal. This is not in any way a pickup in volatility. It is a reversion to the mean.
Okay. Now let's take a look at currencies, because obviously currencies drive this asset class in a way that they perhaps don't in the developed world. What we're looking at here is the famous fragile 5 countries with high current account deficits, which really took a tumble once the Fed started talking about tapering last summer. They really don't look quite so fragile these days. I mean, the rupee is made up more than half of what it lost. Why have we seen that kind of a recovery? What does that tell us about the class?
Well, you raise an interesting point, which is exactly when they were named the Fragile 5 is exactly when they started to do better.
Right, around about August of last year, right?
Yeah. So I think what happened is you had a very aggressive policy response from many of these countries, from Turkey in particular, where they raised interest rates, which at least for the time being has helped to stabilize these currencies. So really the reason is that in many of these instances there was a policy response which dealt with the issue. Now, that doesn't mean they won't appreciate further, but for the time being, that response has given investors some comfort.
Okay, now, what does that mean for how we go about investing in EM? Plainly, there are interesting arguments about active versus passive, and the debate is even more interesting when it comes to emerging markets, because arguably those markets aren't as efficient, aren't as well designed for passive investing. How should one go about this?
You know, I think right now we believe we're in a period when it does make sense to differentiate within emerging markets. You can do that with active managers. You can do that through particular products that focus on a country or a sector, segment of the market. But the reality is that the name emerging markets is becoming a little bit misleading to the extent you're seeing some very different countries in very different states of their economic cycle with very different policies. So this is a period when investors really do want to differentiate even within a country. You know, take for example Turkey. This is a country that's going through a lot of volatility, but that volatility has led to some incredible bargains for particular stocks, specifically in the banking sector.
Right, so this is interesting given that BlackRock is famous for offering large numbers of very broad passive investments in emerging markets. You're still saying that broadly speaking, there is a case for more differentiated or even active investing.
There's definitely a case for differentiation. You can get there in different ways. You can have an active manager. You can make certain decisions based on country or segments of the market. But again, I think the key for investors right now is that differentiation, looking for particular opportunities rather than one blanket exposure, is probably going to be a better strategy.
Okay, Russ, thank you very much indeed. I couldn't agree more. If you want to invest in emerging markets, there probably is quite a lot of value there to be found. It probably does make more sense, particularly in the short term, to try being very picky about looking for that value.